Welcome to the Development Journal, where today we are witnessing the raw industrialization of artificial intelligence as $500 billion in infrastructure spending forces the Wild West of development to be paved over by a rigid, standardized software stack that requires every engineer to change how they build and deploy. We are digging into the massive shift at Hugging Face as they unify the post-training workflow through their new version 1.0 release, while also looking at the transition in Kubernetes management, as Helm version 4 mandates the open container initiative to fundamentally alter how we handle package registry and custom resource definitions. The scale of this shift is hard to overstate because we see traditional software development pipelines being replaced by automated and highly regulated systems that represent a total reorganization of how technical debt and infrastructure are managed as the industry scales to meet an unprecedented and growing global demand.
Sloan, those numbers are massive, but I am looking closely at the market reaction for Microsoft and NVIDIA to see whether the anticipated bounce for Microsoft can hold against partnership frictions as we start our deep dive into the industrialization of the software stack and the new standards at Hugging Face and Helm.
The shift we are seeing with the release of Transformer Reinforcement Learning version 1.0 marks a massive turning point for the industry. By moving from an experimental research repository to a production-ready framework, Hugging Face is effectively ending the Wild West era of model fine-tuning through a standardized application, programming interface that any business can adopt. This new version introduces a unified command line interface that provides consistent entry points for supervised fine-tuning and direct preference optimization. It eliminates those messy manual training loops that used to require bespoke code for every project. Now, engineering teams can finally focus on the quality of their data instead of wrestling with the underlying training logic. What really captures the imagination is the introduction of group relative policy optimization. By removing the separate value or critic model typically required in standard reinforcement learning from human feedback, they have significantly streamlined the entire stack. This makes sophisticated alignment techniques accessible to smaller enterprise teams who previously lacked the specialized hardware or expertise to compete with industry giants. The real human impact comes from the democratization of these tools through parameter-efficient fine-tuning techniques. We are talking about enabling the fine-tuning of multi-billion parameter models on consumer-grade hardware using low-rank adaptation. This prevents the artificial intelligence revolution from being locked behind the gates of only the top 1% of well-funded laboratories.
The accessibility is a compelling narrative, but the efficiency gains are where the actual engineering hurdles get cleared. Integrating unsloth kernels to achieve a 2x increase in training speed, while cutting memory usage by up to 70% for standard workflows is vital. It is the only way to manage multi-billion parameter models without having a bottomless budget. However, I am looking at that new experimental namespace with some caution. While the library is more stable, the fact that cutting-edge developments like online direct preference optimization are still isolated suggests the core framework still has significant gaps. We are seeing a lot of promise here, but the production readiness might be limited to very specific paths. The real engineering win here is how they are bridging the gap between a single local graphics processing unit and multi-node cluster training. By leveraging the Hugging Face Accelerate library, they have simplified the distributed scaling process significantly. It allows a developer to start on a workstation and scale to a massive cluster without rewriting their entire pipeline. This movement toward professional standards in the training layer is just one part of the larger puzzle we are tracking. Now, we need to shift from the model training layer down to the deployment and distribution layer, where Kubernetes is getting its own set of professional standards with the release of Helm version 4.
This new mandate for Open Container Initiative registries as the primary distribution method by the year 2026 is a massive win for simplicity. By eliminating the need for specialized infrastructure like Chart Museum, the project is finally streamlining the vendor landscape for every platform engineering team currently struggling with tool sprawl. I am particularly optimistic about the introduction of native custom resource definition, lifecycle management within the core framework, allowing complex operators like Istio or Prometheus to update their own definitions automatically without requiring manual intervention from site reliability engineers, removes one of the most painful friction points in modern enterprise cluster maintenance. Replacing the outdated pretty good privacy signing process with the SigStore ecosystem. And cosign is another bullish signal for software supply chain integrity, moving toward keyless signing and verification against a transparent public ledger, provides a level of security that the industry has desperately needed as Kubernetes deployments become more mission-critical. This shift toward professional standards across the entire Kubernetes ecosystem is finally catching up to the needs of global enterprises. By providing these native capabilities, the project is ensuring that the tools we use for deployment are just as robust and secure as the high-performance applications they are designed to host.
While those professional standards sound elegant on paper, the real architectural heavy lifting happens under the hood, where they have decoupled the rendering engine from the registry retrieval process. This specific change is essential for tools like Flux or Argo, because it enables much faster and more reliable synchronization across distributed clusters. I have significant reservations regarding the move toward automated patching for those custom resources, despite the convenience it offers. While it does eliminate the need for manual command line interface steps, placing that much trust in upgrade logic creates a high-risk scenario where a single logic error can break a cluster. We should also look at the integration of modern JavaScript object notation schema standards for meticulous validation of user values. By halting a deployment immediately when it detects undocumented or malformed variables, the system prevents the kind of silent failures that often lead to catastrophic and expensive production outages for large enterprises. The project has also refactored the command line interface to support strict output formats like yet another markup language and JavaScript object notation, which makes life easier for automation. Having predictable machine-readable data allows developer portals and platform engineering pipelines to consume status updates directly, bringing a professional level of rigor to how we manage these deployments. The capital requirements for this new era of computing are reaching levels that would have been unthinkable just a few years ago. We are looking at global cloud infrastructure spending that is forecasted to surpass $500 billion by 2026. This represents a massive 27% increase as companies scramble for capacity. Looking at the fourth quarter of 2025 alone, quarterly spending hit $110.9 billion. That is a 29% year-over-year growth rate, which highlights a fundamental change in how resources are consumed. A single artificial intelligence tool deployment can now exceed the entire resource demand of legacy software packages. These unexpected infrastructure resource spikes are forcing a radical shift toward hybrid cloud models to keep high-performance costs under control. Enterprises are moving specific workloads back to private systems because the public cloud bills are becoming unsustainable. It is a defensive move against the unpredictable nature of real-time artificial intelligence processing requirements. Even with reserved capacity plans and vendor-specific dashboards, the pricing for training and inference remains incredibly complex for most information technology departments. Reliance on specialized graphics processing unit hardware from providers like Amazon Web Services and Google Cloud is creating a bottleneck where the sheer volume of data being processed overwhelms the current available supply.
Vance, your focus on those quarterly peaks really underscores how artificial intelligence has moved definitively from the experimental lab into the absolute core of business operations, reaching nearly $400 billion in annual spending. during 2025 shows that the technology is no longer a curiosity, but the primary engine driving global enterprise strategy. I find it fascinating how organizations are utilizing those sophisticated vendor dashboards to navigate the transition toward hybrid environments. By carefully balancing their private infrastructure with public cloud flexibility, they are attempting to capture the benefits of rapid innovation without losing their financial footing. It is a delicate dance between agility and fiscal responsibility in a high-stakes market. The aggressive deployment of specialized hardware by the major cloud giants is a testament to the long-term conviction they have in this path. While the costs are indeed high, the potential for these systems to redefine productivity across every sector justifies the investment for many global leaders. We are witnessing a foundational rebuilding of the global technical stack in real time. This immense surge in cloud providers spending naturally leads us to evaluate the primary beneficiary of all this demand for high-performance hardware. The massive capital being poured into data centers is flowing directly toward the silicon that powers these models. We should examine the 21-day outlook for NVIDIA as they prepare for the next wave of adoption. The recent $2 billion strategic investment in Marvell technology demonstrates that this silicon giant is thinking far beyond just the individual chip. By expanding its NVLink ecosystem and strengthening silicon photonics capabilities, the company is effectively securing the entire interconnect layer to ensure their hardware remains the gold standard for high-performance connectivity. Looking at current technical indicators, the relative strength index has dipped to 42.19, which signals that the stock is approaching oversold territory. This suggests a potential upward reversal from the current price of $175.75 back toward that 52-week high of $212.19. The rollout of the Blackwell Ultra platform is expected to be a major catalyst for this price movement over the next 21 days. With a year-over-year revenue growth rate of 65.47%, the momentum behind their next-generation architecture seems robust enough to overcome any short-term cooling in the broader market.
That momentum only tells part of the story when we consider how they are funding these massive strategic bets without breaking a sweat. A staggering return on equity of 101.48%, combined with a gross margin of 71.07%, gives them a level of operational control that is practically unheard of, maintaining a net margin of 55.60%, while generating over $96.68 billion in free cash flow, provides a massive safety net for their research and development. This allows the company to absorb the heavy costs of integrating Marvell, while continuing to dominate market capitalization at $4.27 trillion. Investors should still be cautious about the high beta of 2.38, which indicates that this stock is incredibly sensitive to any global macro shocks. Even with the Blackwell adoption moving forward, a sudden escalation in the Iran conflict could trigger significant volatility that technical indicators like the relative strength index might not fully capture. Their ability to keep selling and general administrative expenses under such tight control while scaling at this speed is a testament to their pricing power. Yet, the sheer concentration of value in one company means any disruption to the silicon supply chain would have an outsized impact on their ability to reach those projected technical targets.
That volatility highlights the delicate balance between the hardware providers and the massive enterprises that rely on their chips to stay competitive. Contrast the hardware dominance we see with NVIDIA against the friction occurring at its biggest customer and partner, Microsoft, as they navigate an increasingly complicated relationship with open artificial intelligence and their own internal resource constraints. The tension between Microsoft and open artificial intelligence is reaching a boiling point over that $50 billion Amazon Web Services agreement. This potential litigation threatens the very exclusivity rights for Azure that investors have banked on. If the foundation of this partnership cracks, the primary driver of their enterprise cloud dominance could be fundamentally compromised for years. We are seeing the market react sharply to these cracks in the foundation, pushing the relative strength index down to a heavily oversold 26.91. Even with these structural concerns, the gap between the current price and the analyst consensus target of $587.31 suggests a massive disconnect in valuation. History suggests that a 5% relief rally is highly probable as we approach the earnings announcement on April 29th. Investors often look for a safe haven in companies that generate over $136 billion in operating cash flow. This positioning ahead of the report could provide the temporary floor the stock desperately needs right now. Vance, when you look at the sheer scale of their spending, do you think the market is overreacting to the friction? Or is it actually pricing in the massive risk of that $120 billion capital expenditure plan failing to deliver the expected returns on their internal infrastructure?
The 25.8% price decline this year is a direct reflection of anxiety surrounding their capital-intensive strategy. While $120 billion in projected spending is staggering, the lack of clarity on how this infrastructure translates to margin expansion is keeping many institutional buyers firmly on the sidelines for now. Despite the heavy spending, their operational efficiency remains a bright spot with a gross margin of 68.82%. They are still an incredibly profitable machine, maintaining a net margin of 36.15%. However, these metrics are backward-looking and do not fully account for the rising costs of maintaining this competitive edge. If Azure revenue growth continues to decelerate in the coming quarters, no amount of historical cash flow will prevent the stock from testing that 52-week low of $344.79. The market is increasingly unforgiving toward companies that miss their growth targets while simultaneously increasing their internal resource requirements to such extreme levels. That skepticism regarding enterprise returns explains why the focus is shifting away from the back-end cloud wars. We need to look at how different the landscape appears when we move from the enterprise-heavy Microsoft environment to Apple and their consumer-facing artificial intelligence strategy as they approach their 50th anniversary.
Apple is approaching their 50th anniversary with a level of momentum we rarely see in mature technology giants. The upcoming launch of the MacBook Neo is not just a hardware refresh, but a pivotal moment for consumer-driven artificial intelligence monetization. It feels like a perfect storm where heritage meets a brand new product cycle. To support this vision, they are injecting $400 million into United States manufacturing to ensure these artificial intelligence announcements have the physical infrastructure they need. This massive commitment to domestic production signals a serious shift in how they plan to control their supply chain while pushing the boundaries of edge computing. The market sentiment reflects this optimism with a bullish news score of 67% as we head toward the April 30th earnings date. With a consensus price target of $295.07, there is significant room for the stock to climb from its current price point. Vance, do those strong growth projections hold up when you strip away the anniversary hype and look at the actual liquidity position they are maintaining to navigate potential supply chain disruptions? I wonder if the balance sheet can truly support such aggressive hardware expansion while they are simultaneously managing these global logistics hurdles.
While 19.50% year-over-year earnings growth is impressive, the current ratio of 0.89 is a flashing yellow light. This suggests liquidity constraints if manufacturing delays occur. Their massive free cash flow of $98.77 billion provides a cushion, but short-term flexibility remains surprisingly tight. The technical picture is far more muted than the headlines suggest, with a relative strength index of 49.82, which is almost perfectly neutral. This means the market is waiting for hard evidence of revenue growth beyond the current 6.43% before committing to that higher price target. We cannot ignore the operational efficiency, though. With a gross margin of 46.91% and a net margin of 26.92%, they are squeezing incredible profit out of every device sold. which is essential as they pivot toward these high-cost artificial intelligence integrated hardware cycles in the coming years. Final wrap-up on how these financial giants are effectively underwriting the technical standards we discussed in the first segment. By pouring billions into these infrastructure and product shifts, they are forcing the entire industry to adapt to their new definitions of computational power and efficiency for the next decade of development. Hugging Face standardizing reward modeling and Helm 4 mandating Open Container Initiative registry usage are significant milestones. These technical guardrails represent a fundamental shift in managing complexity. With $500 billion in infrastructure spending, this industrialization phase leaves absolutely no room for unoptimized software patterns.
Those technical guardrails justify such a monumental $500 billion investment in hardware. By turning post-training workflows into repeatable standards, companies are building the factory floor for artificial intelligence. This moves the conversation from experimental research toward a predictable production cycle that can actually generate real returns. As these standardized stacks take hold, the divide between hobbyist projects and industrial-scale intelligence will widen. We are watching the architecture of the next decade being written through these massive capital deployments. Thank you for joining us on the Dev Journal today, and we hope these technical insights help you navigate this landscape.